Hello and welcome to Business Standards Morning Show. I am Ruchika Chitravanshi and let us take a look at the stories for today. The economy is likely to grow at a conservative 8 to 8.5% in the fiscal year 2022-23, and the country is geared up to face the challenges posed by pandemic, the economic survey tabled yesterday said. It also claimed that the economic activity has recovered to pre-pandemic level but cautioned on some risks. This story analyzes what this yearly report card tells us about the condition of the economy and the risks ahead.
The annual pre-budget economic survey, compiled by Principal Economic Advisor Sanjeev Sanyal this year, starts by highlighting India's agile policy response to the COVID-19 shock. The agile framework is based on feedback loops and real-time monitoring of actual outcomes, differing from the conventional waterfall strategy of introducing front-loaded stimulus packages. The agile approach is aided by 80 high-frequency indicators in an environment of extreme uncertainty such as now. The survey reverted to the single volume format after 8 years as the two volume format was becoming unwieldy, according to Sanyal. The economic survey projects India's GDP to grow 8 to 8.5% next fiscal, supported by widespread vaccine coverage, gains from supply side reforms, robust export growth, and the availability of fiscal capacity to ramp up capital expenditure when required. The forecast is below the IMF's projection of 9%. The survey states that vaccination should not be seen merely as health response, but as a macroeconomic indicator for now. The GDP projection is based on the assumption that there will be no further debilitating pandemic-related economic disruption, monsoon will be normal, withdrawal of global liquidity by major central banks will be orderly, global supply chain disruptions will steadily ease over the course of the year, and oil prices will be in the range of $70 to $75 per barrel. While the first four assumptions seem rational, the fifth on oil prices looks hopeful as analysts expect Brent crude to average at around $80 per barrel this year or even higher due to geopolitical risks emanating from Eastern Europe. Brent topped $90 last week for the first time since 2014 and may go up to $120 over the next few months. However, the economic survey does say that India needs to be wary of imported inflation, especially from elevated global energy prices. Economists Madan Sabnavis and Dharmakirti Joshi spoke to us on the key takeaways from the economic survey.
Okay, the economic survey presented today presents a very positive picture of the economy, both for the year gone past, that is 21-22, as well as for 22-23. But I think the interesting part is that for 22-23, the number of 8 to 8.5% is interesting. Because we and Bank of Baroda had actually a projection of 7.5%. The IMF has something like 9%. So I think the government is being fairly conservative. They're very gung-ho about investment picking up. So I think it's going to be a combination of investment and also the pent-up demand, which probably did not materialize fully in 21-22, which is going to play out in 22-23. If crude oil prices remain high, it would necessarily mean problems on the currency, interest rates, and probably it would go on inflation and finally on interest rates too. But I think it's a fairly reasonable assumption, 70-75 to make for the full year. And they're looking at inflation more in the region of around 5.5%. Overall, we can look at the budget growing at around 13.5%. That will be the GDP growth rate which the government will assume. The fact that the economic survey says that there's a lot of fiscal space which is available, I think it's based on the fact that growth will be high, tax collections will be high, and the government needs to just use this additional support which you're getting from higher tax revenue in the form of higher expenditure. So the focus is, of course, on capital expenditure. One interesting thing is that the economic survey also says that banks are very well capitalized, which means that the burden on the government to do any kind of recapitalization of banks may not be required this year.
Well, I think the economy is in a recovery mode. I think they are talking of 8 to 8.5% GDP growth in 22-23. Given that the new risks are in the horizon, and some of them are already playing out, like high crude prices. Also, I think geopolitical risks are heightened. And on top of that, the monetary policies across the systemically important central banks, I think, are about to turn. I think all these things do create headwinds to growth. So I would say that the risk to outlook is currently loaded downwards.
Interestingly, the economic survey uses satellite imagery to highlight India's infrastructural growth. For example, satellite photos of nighttime luminosity between 2012 and 2021 shows the expansion of electricity supply, economic activity, and urban expansion. Other images show the extent of urban expansion in certain localities of cities like Gurugram, Bengaluru, and Mumbai over time. The survey acknowledges that India's economic response to the pandemic emphasized more on supply-side reforms than on the demand side. Some of these include production-linked incentive schemes, removal of retrospective tax, liberalized guidelines for BPO sector, telecom sector reforms, and revised definition of MSMEs. Whether the budget will offer demand-boosting measures such as cutting income or fuel taxes and enhancing income tax deductions will be known in a few hours.
Through the economic survey, the government reasserted its commitment towards privatization and strategic disinvestment of public sector enterprises. It said that the sale of Air India generated disinvestment proceeds and was key in boosting the government's privatization drive. But where the airline flies from here, what are the challenges the Tata Group will face in ensuring that the Air India's flight is smooth? Our next report tells us more.
While recalling the first flight from Karachi on 15th October 1932, which carried 25 kg of airmail letters for then Bombay, Jehangir Ratanji Dadabhai Tata had said, and I quote, "On an exciting October dawn in 1932, a puss moth and I soared joyfully from Karachi with our first precious load of mail on an inaugural flight to Bombay. As we hummed towards our destination at a dazzling 100 miles per hour, I breathed a silent prayer for the success of our venture and for the safety of those who worked for it. It appears that JRD's silent prayer has been answered. Last Thursday, Air India took off from the government's runway and landed in the founder's fold. The government gave the airline back to the Tatas after about 7 decades, a period marked by inefficiency which plunged the airline into huge debt. As on 31st August 2021, the airline's total debt was 61,562 crore rupees. Air India also had about 15,000 crore rupees excess liabilities towards unpaid fuel bills and other operational creditors. And now, as Air India takes off to reclaim its lost glory under the Tata Group, it will face turbulence in the form of major challenges that need to be addressed. For one thing, the Tatas have taken over the airline at the worst possible time. According to the Telegraph, because of the COVID-19 pandemic and high fuel costs, India's airlines are forecast to be headed for their biggest ever loss of over 20,000 crore rupees in this financial year. Consider also that Air India never made a profit since its merger with Indian Airlines in 2007-8. In fact, it reported a loss of 7,017 crore rupees in FY21. Now that they are back in Air India's cockpit, the Tatas aim to provide enhanced in-flight services and improved on-time performance. They also have to foster corporate culture among the airline's employees. According to a Business Daily, issues such as older aircraft and inferior cabin products also need to be addressed. Next comes the upgrade and maintenance of the fleet. While Air India has a fleet of 141 aircraft, a mix of narrow and wide-body Airbus and Boeing planes, the airline has agreed to hand over only 118 of them in flyworthy condition to the Tatas. Air India also faces a severe shortage of parts and engines for the 787 fleet. The Tatas have found that at any given time, there were at least 5 787s lying unused due to the unavailability of engines. Similarly, on the Boeing 777 fleet, the mainstay for Air India's lucrative US operations, at least 2 aircraft have been found not fit to fly, while the remaining need heavy refurbishing. Clearly, the Tata Group has its job cut out for it. So, we spoke to 2 aviation experts to get a better understanding of the challenges that the salt to software conglomerate will face as it tries to turn the loss-making carrier into a world-class airline.
As far as long-term challenges go, you see the vast majority of the fleet at Air India is owned by Air India, which is very unlikely compared to all the other airlines, which predominantly obtain aircraft on leases from foreign lessors. Now, in this case, Air India would need to refurbish these aircraft. Now, each aircraft refurbished costs a couple of $1 million. And I mean, it obviously depends on what sort of amenities you'd want to offer. But, especially on the long haul fleet now that operates to Europe and the US, Wi-Fi is pretty common, on these routes and is offered by all their competitors. So, making sure that their in-flight product, the seats in the premium cabins, the in-flight entertainment. So all of this needs to be spruced up. And the other one obviously being competition, be it the Gulf Airlines or airlines in Europe who they compete with head on, not just from a product standpoint, but when you talk about the Gulf Airlines, it's obviously from a service standpoint. They are vastly, greatly customer service oriented. And I'm not saying that we aren't. The Tata Group owns the Taj hotels and they own some of the world's best hotels in the world. But the challenge really lies in, would they be able to bring all those expertise that they have within the group to Air India and sort of roll it out in a way that can be done that can be done where keeping in mind morale and staff and obviously costs and operational issues.
An equally important challenge is how the Tata Group will structure its aviation interests. Vistara chairman Bhaskar Bhatt has told a Business Daily that the airline will coexist with Air India, and at the moment there are no merger talks between them.
Each airline will function separately and each airline will function uniquely. If you want to look at the closest parallel example of how Tatas would run all the airlines with Air India, I think you need to look at how Lufthansa is today. Lufthansa Group AG has Lufthansa Airlines. They own Austrian Airlines. They own Swiss International Airline. They own Germanwings, which is a low-cost airline, which is one of the largest European operators. They own a joint venture with Sun Express, with Turkish Airlines called Sun Express. They also have a joint venture with Japan Airlines, which is called ANA. So what Lufthansa has is a airline product for every level and tier. And I think that is something which that is something in the same manner in which Lufthansa has done it. We'll see that with Air India. Air India by itself will be this large global international networked airline where all other airlines would form synergies with an Air India. So I don't think they would compete with each other. And why should they compete? Swiss International Airlines, Austrian Airlines is all owned by Lufthansa, but they don't compete with each other. So they are a unique airline for each region and they grow organically. And I think organic growth now will be the strategy.
However, despite all the challenges awaiting the Tata Group, it has already taken off on time.
I really do believe that the Tata Group will put its full strength behind the venture in terms of its strategic game plan, its human resource capability, its financial strength, its marketing capability, and therefore it will present a huge value upside for our customers, both in terms of a new product profile and a value proposition, and a new service benchmark. As you've already seen, the first flight this past yesterday, was concentrated on OTP, on-time performance. Right. And that change you're already seeing happen along with changes in in-flight menus as well as service capabilities and so on and so forth.
In a recent and widely shared tweet, dairy giant Amul has summed up Air India's takeover very well. with the famous Amul girl sharing a plane's cockpit with Tata Sons chairperson N. Chandrasekaran and the Maharaja. A tagline in the advertisement says, "In good hands." Tata Group, which owns Tetley Tea to Jaguar Land Rover, may turn Air India into a profitable venture soon.
Over the years, markets have positively reacted to budgets presented by the Modi government. Last year's pro-growth budget saw the benchmarks climbing over 5%. So will the markets repeat their 2021 performance, or will bears outweigh the bulls today? Equity markets started the budget week with solid gains on Monday as supportive global cues and anticipation of a populist budget drove investors towards the Lal Street. The S&P BSE Sensex surged over 1,000 points to 58,248 levels, while the Nifty 50 index moved 300 points to 17,407 levels in intraday deals. The indices, however, ended at 58,014 and 17,340 levels, rising 814 and 238 points respectively. As all eyes will be on budget proposals today, let us look at past data to know if equities could rally post the budget or will they see profit booking. An analysis by Business Standards Research Bureau shows that 38 budgets have been presented since 1991. Markets on their part have risen and fallen almost equal number of times. The Sensex index has clocked a post-budget rally 50% of the times, while the Nifty index has ended in the green 58% of the times. Meanwhile, market reaction to Modi government's budget has largely been positive. Stock markets have mostly rallied strongly post the union budget and have risen 58% of the times. This time around too, analysts expect bulls to give a tough fight to bears. Let us go to Gaurang Shah, Senior Vice President at Geojit Financial Services, to know what the markets are baking in.
Over the last couple of years, I think slowly budget, the significance that was there earlier is fading away.
Okay.
So it is a 2 day before and 3 days prior. The budget. 2 days before in terms of anticipation and 3 days post budget in terms of understanding what is the fine print.
So if markets were to rally today, should one sell on rise?
According to just a brief from what the Honorable Prime Minister said before going into the Parliament, before the economic survey was submitted, that India is well placed in terms of its growth trajectory, and the government will do whatever necessary to keep it that way and increase the run rate of GDP. Now, if you have to go by that very small statement that the Honorable PM made, it gives you a slight indication that possibly there is something good out of budget expected. But this is just all wishful thinking, to be very frank with you. And not only budget, Puneet, post budget also, I think there is a lot that we have to see.
Sure.
So if you are a short to medium term investor and if you bought stocks only with budget in mind, then sell the rally tomorrow.
According to the annual economic survey tabled in the Parliament yesterday, India has the fiscal space to do more to support the economy, poised to wrest the title of the world's fastest growing major one from China and keep it for at least another 2 years. Moreover, according to the document, gross domestic product is expected to grow by 8 to 8.5% in the year starting April, after likely expanding 9.2% in the current year. If one is to take cues from the economic survey about today's likely proposals, then the government is expected to drive growth by widespread vaccine coverage, gains from supply-side reforms and easing of regulations, robust export growth and availability of fiscal space to ramp up capital spending. Given this, Sampath Reddy, Chief Investment Officer at Bajaj Allianz Life Insurance, says, the union budget to be growth-oriented with emphasis likely to be on sectors like manufacturing, healthcare and infrastructure. Given the government's commitment towards climate, we expect the electric vehicle segment to get an additional boost with specific incentives for the charging infrastructure. Moreover, as the direct and indirect tax collections are picking up, we expect the government to achieve its budgeted fiscal deficit target of FY22.
the government has already announced National Monetization Pipeline, PLI schemes, and increased outlay for capex, and we expect that the thrust to continue going forward as well. Overall, today's proposals will be the key market drivers over the next few days, with stock-specific action amid Q3 results and global cues swaying indices.
A considerable chunk of the country's population is glued to TV sets or mobile phones on the budget day to know about the announcement on personal taxation as it affects them directly. In the 2020 budget, Union Finance Minister Nirmala Sitharaman had introduced a new tax regime. The next report tells us more about the difference in slab rates between the new tax regime and the old tax regime.
Announcement on income tax is the most awaited part of the union budget. Unlike every year, people are expecting to get some relief. They had it last year in the form of a new tax regime. Let us find out more about it. Under the new tax regime, the tax rates are reduced for those willing to forego tax exemptions and deductions. The new tax regime remains optional for taxpayers. This means a taxpayer has the option to either stick to the old regime or choose the new one. Currently, income up to 2.5 lakh rupees is exempt from taxation under both regimes. Income between 2.5 lakh rupees to 5 lakh rupees is taxed at the rate of 5% under the old as well as the new tax regime. Personal income from 5 lakh rupees to 7.5 lakh rupees is taxed at a rate of 20% under the old regime, while under the new regime, the tax rate stands at 10%. Income between 7.5 lakh rupees to 10 lakh rupees is taxed at a rate of 20% in the old regime, while in the new regime, the tax rate stands at 15%. Under the old regime, personal income above 10 lakh rupees is taxed at a rate of 30%. However, under the new regime, there are 3 slabs above 10 lakh rupees. Personal income between 10 lakh rupees and 12.5 lakh rupees is taxed at a rate of 20% under the new regime. Income from 12.5 lakh rupees to 15 lakh rupees is taxed at 25%, and income above 15 lakh rupees is taxed at a rate of 30%. The effective tax rate is much higher due to cess and surcharges. An individual with a net taxable income of up to 5 lakh rupees is allowed to avail tax rebate of up to 12,500 rupees under Section 87A in both the old as well as the new tax system. So, effectively, the tax liability of individuals with income up to 5 lakh rupees is zero under both the tax regimes.
A pre-budget survey conducted by a national daily claimed that most salaried individuals expect the government to give a substantial tax relief against the backdrop of pandemic. They expect the government to increase the basic exemption limit to 3 lakh rupees from the current 2.5 lakh rupees due to the soaring inflation. That is all we have for you today. We will be back with more news and analysis. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.